Yeah, so just a quick disclaimer before we proceed on in the session, not financial or legal advice. And let's have a look at this chart lah. Mr. Sani, I'm not so sure if you can see it when you're driving, but anyways, it's just a chart of the Sing dollar against the Malaysian ringgit. And things are not looking good. Okay, since the start of the year itself, January 2024, the Singapore dollar has gained 2.56 against our local note. And if we zoom out to a longer time frame, since January 2022, Sing dollar has gained 15.46%. So if we extrapolate the data and put it to a 2-year return, the annual returns is 7.45%. Now this return, to give you guys a quick idea, is higher than EPF's 5-year annualized return of 5.65%, around there, and 87% of unit trusts in Malaysia. So just by holding the Singapore dollar in these 2 years, right, you would have already beat more than 87% of unit trusts in Malaysia, as well as EPF. So Mr. Sunny, where do we even start? Okay, I just want to ask you this quick question. I'm sure you're busy celebrating right now since you're living and spending in Singapore. You can, convert your Sing dollar to Malaysian ringgit. You probably live like a king when you come back here. But is this the Malaysian ringgit's problem, or are we, looking at Sing dollar's strength also, or is it a combination of both?
I think the last one, I think it's a combination of both. Because I think the way to always look at currencies, because they're always a pair, Sing and Ringgit, right? And the way to test whether a certain currency is strengthening, has strength, or is weak, is you try and look at the several different types of pairs. So you just don't look at dollar Sing, you just don't look at Sing Ringgit, you look at Sing Baht, you look at Sing Rupiah, you look at Ringgit Baht, you look at Ringgit Rupiah, and so on and so forth. So I think the conclusion when we talk about Sing and Ringgit is there is Sing strength, because Sing is strengthening against most other currencies. And there are elements of ringgit weakness also, because I think we do see a tad of ringgit weakness against rupiah and so on and so forth. Yeah. So I think it's a combination of both.
Yeah, let's just focus on the later factor which you mentioned, which is the ringgit weakness. Fair to say the ringgit's weakness is mostly due to the difference of interest rates, right? Because global central banks such as the UK, US, Europe, all except Japan, they've raised interest rates aggressively in the past 1 or 2 years, and they've kept them much higher as compared to Malaysia. So some context, US interest rates currently at, if I'm not mistaken, 2 to 3 decade high, 5.5%, but Malaysia's interest rates is at 3.0%. So is it fair to say that MYR's weakness is mainly deriving from the difference of interest rates between these countries?
Yeah, I think you can say so, but I think the way to look at it is there are different time frames to look at certain currencies, say for example the ringgit. Okay, so you have a long-term time frame and you have a short-term time frame. The short-term time frame tends to be governed or tends to be influenced by things like interest rate differential, movement of hot money in and out of Malaysia. The longer time frame is tend to be more governed by foreign direct investment, your export competitiveness, your balance of payment, so on and so forth. Some of the key accounts in your balance of payment. So you are right to say that the interest rate differential has a role to play short term. But let's not forget also that in the long run also there are other factors. The overall, if I may just use 1 or 2 more minutes, the overall trend or the overall movement of the ringgit is dependent on what we call the balance of payment. It's broken up into the current account, which is export and import, whether it's goods and services. And then another major one is the financial statement or the financial account. That can be broken up into what we call short-term and long-term. Short-term is a bit of a hot money, equity kind of inflows and outflows and such. The long-term is the FDIs and so on. So it's the movement of the ringgit is really a confluence of all these factors. It's just that we don't know for certain sometimes which factor is overwhelming at certain points. So really, at the end of the day, the thing pushing the ringgit in one particular day itself or one particular period itself, sometimes it's very hard to decipher what is the actual reason for that movement in the ringgit itself. So I think we just have to bear that in mind, because some people tend to look at the ringgit's performance and come to a very quick conclusion that it's because of this, it's because of that. Sometimes it could just simply be, for example, one particular large trade flow, capital movement, FDI movement, that in itself can also affect the ringgit on a day-to-day basis. So I just wanted to make sure that everybody understands, sometimes it's not only just interest rate differential and such. Sometimes it could actually be other factors involved.
Yeah, other factors also include political factors, and
Exactly. So
Yeah.
so if there was a bad sentiment, for example, you could effectively see short-term outflows. But if the long-term inflows were still there, were still intact, then you can safely say that that was just a short-term anomaly in the ringgit weakness, and the long term is still positive. So really, it's all these things coming together.
Yeah. So let's move on over to the Sing dollar strength, lah, which is the first factor that you mentioned. And you're right, lah, because when comparing the Sing dollar to other major currencies such as the British pound, the Japanese yen, and the euro, SGD has strengthened quite significantly since 2021. So it's sort of like a double whammy, lah, in the case of the Malaysian ringgit versus Singapore dollar, because first we talked about the Malaysian ringgit weakening due to internal factors, yeah, political factors, as well as difference of interest rates between Malaysia and other global central banks, right? And then the second factor towards the strength in the SGD-MYR pair is that the Sing dollar itself has also been strengthening. So, Sani, do you mind elaborating more on why we are seeing such a resurgence or such a strength in the Sing dollar versus other major currency pairs, all except the US dollar? Because this chart over here shows that even though SGD has been strengthening versus majority of other currencies, the US dollar is pretty much the same, SGD versus USD.
Okay, so at the end of the day, it's the same factors that affect the ringgit, affects the Sing dollar, and also for all our currencies, i.e., the balance of payment and all those flows which I was talking to you about. So Singapore, in a way, attracts a lot of capital. In recent years, in recent months, it's attracted a lot of capital from Hong Kong, from China, and so on. So that could be a factor. But I think the underlying thing is we must remember that Singapore itself conducts its monetary policy via its currency. It is one of the very few countries in the world which does not adopt a monetary policy based on interest rates. Like the Federal Reserve, Bank Negara, inflation comes in, you raise interest rates. You want to stimulate the economy, you reduce interest rates, and so on. Okay. In Singapore, because many things are being imported into Singapore, more than 90% of stuff is not produced locally. The tendency or the risk is always to import inflation into the country. Because Singapore imports the vast majority of stuff into the country, the best way to combat inflation is not to raise interest rates, is to strengthen the currency. Okay, so when you strengthen the currency itself, you are effectively buying things cheaper from overseas. So that is Singapore's monetary policy. When there's inflation, they actually strengthen the currency, and therefore they manage the currency within a certain band. So the big question over the long run is this: is inflation a structural issue throughout the whole world, and does it remain over the long run? So if the answer is yes, there will always be inflation. It's just a question of whether it's 1, 2, 3, 4, 5, 6%. Then effectively the Sing dollar would actually strengthen accordingly, i.e., will strengthen over the long run because it has to combat that inflation over the long run. So that is why we do see the Sing dollar creeping up, sometimes fast, sometimes slower, vis-a-vis not only the ringgit but other currencies, because it's being managed intentionally to strengthen in order to avoid Singapore importing inflation into the country.
So let me just track back a few steps for some of the people who are confused in the audience. Okay, so first of all, Singapore does not control domestic interest rates. Yeah, they do not rely on interest rates, unlike Bank Negara Malaysia or the Federal Reserve. Okay, as you can see over here, domestic interest rates in Singapore are largely determined by global interest rates. And then Mrs. Sani mentioned just now, Singapore utilizes the exchange rate, yeah, effectively strengthening or weakening the Singapore dollar in order to control inflation. And why are they able to do this? Well, that's because they import most of their items. Yeah, by importing most of their items, they are heavily affected by global inflation. So when you have a stronger local currency, imports become cheaper. That's how inflation within the country falls. So if you take a look at the previous 2 years itself, from 2021 to 2022, yeah, Mr. Sunny, global inflation was peaking, right? I think the US peaked at 9 point something. Singapore's inflation, I'm not entirely sure about this, but I think I peaked at 7.6 or 7.7. And that was when the Monetary Authority of Singapore, or the Central Bank of Singapore, has continued to allow Sing dollars to strengthen, or directly intervening in the FX market, buying up Sing dollars using their forex reserves, and then strengthening the currency to lower inflation within the country. So, did I grasp the major points that you were talking about just now, Mr. Sunny?
Yes, I think correct. Absolutely correct. Yeah.
Yeah, so this is the table of Singapore's monetary policies, like basically every meeting itself. As you can see, since October 2021 to October 2022, MAS has been diligently tightening the monetary policy by raising the slope of the policy band. So, Mr. Sunny, quick question. This slope of this policy band over here, in simple terms, it basically just means the strength of the Sing dollar, right?
Yeah, so it's not a fixed currency, unlike Hong Kong, where more or less you say it has to remain at a certain point. And it's not one whereby the MAS, for example, says, okay, we are going to strengthen the Sing dollar from, let's say, against the ringgit, this example, 3.5 to 3.6 by the next few months to 3.7. No, it's nothing along that line. So it's not a fixed number which they target. Instead, what they do is they actually allow the Sing dollar to fluctuate within a certain band, a certain range, except that that range slowly creeps higher and higher. So, give you an example again. This is not, I have to repeat that this is not the actual band itself, but just trying to give you something to visualize. So, let's say, for example, now it will probably fluctuate between 340 to 370 against the ringgit. Then later on, 12 months time, you'll find that it will be 370 to 4.0, something along that line. So you see, it's creeping higher, and the reason why it's creeping higher is because there's a conscious effort to make it move higher over a certain period of time. So therefore, we economists and strategists, when we look at the Singapore band, and it's actually not just one currency that determines it, but a basket of currencies, we tend to say the nominal effective exchange rate band is creeping higher at a rate of maybe 2%, 3%, or something along that line. So it's really a trade weighted basket. Okay, I know it's a bit technical. It's a trade weighted basket where it's allowed to appreciate, and the monetary authority makes sure that the Sing dollar actually, or rather that number actually remains within a band and continues to appreciate. So I think you have that on your screen. That's the band. So every time it hits the top end of the band or the bottom end of the band, there's intervention to ensure that it remains within the band itself.
So when the SNIA index, or the strength of the Sing dollar, basically falls below this band, MAS will directly intervene in the forex market, buys up Sing dollars, strengthening the local currency. If it goes above the upper portion of this band, yeah, MAS will sell Sing dollars to weaken the local currency, and to tighten the monetary policy, right, i.e., to allow SGD to appreciate even more, MAS can actually adjust the slope of the band, or raise the slope of this band itself, okay, which is what you guys are seeing right here. Okay, in from October 2021 to October 2022, MAS has been diligently raising the slope of the band, therefore allowing SGD to appreciate further. So it's not just the market that is buying up Sing dollars, right, Mr. Sani? It's also the Singaporean government in the previous, 1 to 2 years itself. They've been buying up Sing dollars, when it falls below the band, etc., right?
Correct. So it's the central bank MAS policy to intervene to keep the Sing dollar within this band itself. Yeah. So if the band is sloping up, means they will ensure that the Sing dollar will continue to appreciate against a bucket of currencies, given that it is supposed to be within the band or kept within the band. I think one thing many people must understand also is that not any central bank, not simply any central bank can maintain such a policy. You need, as you mentioned earlier, there were several interventions. So every time it comes out from the band, there's intervention. You need a central bank or a country which has a lot of reserves, which has a lot of credibility. So when the central bank says we'll keep it within the band, and the central bank says that we have enough money to maintain the intervention, the market believes it, and the market doesn't try and do a hanky-panky and try and break the band and so on and so forth. You can imagine if some smaller countries, even like Malaysia or such, tried to maintain such a ban, it would come under speculative attack and so on. So the fact that Singapore has huge amount of reserves, the MAS has massive amount of credibility, helps a lot in maintaining the ban.
Yeah, so when talking about the reserve, right, this is just basically a chart or a table of the forex reserves by country lah. So when we have a look at the SGDMYR chart again, and when we start to extrapolate MAS when they began tightening and when they stopped tightening, you can really see that the rally began when MAS started tightening. Okay, this parabolic rally over here, and then MAS, they continue to hold the monetary policy. So afterwards, when MAS continues to hold, we still see the Singapore dollar continuing to rally. And why is this the case, Mrs. Sani? What do you think is going on over here?
Well, so again, we must remember that the Sing dollar, the trade weighted basket fluctuates within a range. So there will be some time when it actually holds steady. There'll be some time be sloping up and down. And again, it is a pairing rather than a single currency itself. We must understand that currency pairs means that we are now comparing, let's say, for example, fundamental of the Sing dollar, i.e., the Singapore economy, versus fundamentals of the Malaysian economy. People have asked me many years ago when the Sing dollar was at 2 against the Ringgit, 2.5, 3, and so on. They've asked me where I think the Sing Ringgit would go. When it was 2, I said it would probably go to 3. When it was 3, I said it's probably going to go to 4. And the reason I say that again is because all I have to do is when I look at the Sing, I know the Sing is probably on a strengthening path. The only thing that will balance out is if the Ringgit itself would strengthen. And what would that entail? That would entail the Malaysian economy becoming competitive. That would entail the balance of payment moving into surplus, i.e., exports, net exports higher, foreign direct investment coming in, people coming in to buy our bonds and equities, and so on. So the inflows will create ringgit demand that will help to offset basically Sing demand and keep the Sing ringgit either steady or even maybe move into favor of Malaysia or the ringgit itself. Until I see long run reasons to believe that the ringgit is structurally sound, or rather, sorry, the Malaysian economy is structurally sound, i.e. competitive, the Sing dollar strength itself will ensure that Sing ringgit is going to move higher and higher. So this really begs the question of, can the Malaysian economy in the long run be competitive? And we're talking about things like, the debt to GDP is increasing. You can see that the country is falling down sometime over a period of not only now, but over a period of time down the so-called World Competitiveness Index and such. So all of this really, I mean, I think most recently there was a comment on Twitter by the World Bank chief economist who said that, if you want to look at the ringgit weakness, don't just focus maybe on the short term, but look over the long run. And in the long run, it's all about competitiveness. And this is really what I'm alluding to. The long run competitiveness actually drives the long run trend. And we've just moved down many ladders, whether it's World Competitive Index, whether it's the education, math Olympiad, for example, and so on and so forth. So all these things relate to competitiveness, and really that's one of the reasons why ringgit itself, I think, needs to change that in order for the ringgit to strengthen.
Yeah, so things are not looking bright for the Malaysian ringgit. Okay, not just against the US dollar's case.
But
Uh,
yeah, but I want to add one thing also. The currencies, any currency in the world, when they weaken, it doesn't necessarily mean something bad per se. Okay, because if you've been through what we call competitive devaluations, sometimes countries actually welcome depreciation of currencies because it makes them more export competitive, more export competitive. It helps them to compete in the world front, especially if you're a net export country itself. And say, for example, in Malaysia's case, if the ringgit is weaker, every barrel of oil results in Malaysia earning many more ringgits, much more ringgit in terms for its budget, for its and so on and so forth. So there's some positiveness in the weakness, except that it shouldn't last, or it shouldn't be a permanent trend. So I think hopefully the ringgit's weakness now can drive some changes, and that's really what currencies are for. When they go into a certain trend, whether it's strengthening or weakening, it changes the structure of the economy. So maybe now the economy should start thinking, the government should start thinking, how do I, for example, lessen my dependence on the imports of certain goods and services in the country from overseas itself, and so on and so forth. So basically, it should spur changes within the economy to actually effectively ensure that this weakness is not permanent. It's when those changes don't take place, then it becomes an issue over the long run.
Yeah, so hopefully the politicians will do what they are tasked to do lah. But anyway, this is the chart of Singapore's forex reserves over here, and there is no free lunch lah. Okay, I think Mr. Sani, you can chime in on this also. When MAS began tightening to the period when MAS has continued to help the monetary policy, you can see over here that the foreign exchange reserve has fallen significantly, yeah, indicating that MAS has been directly intervening in the forex market, using up their forex reserves in order to strengthen the local currency, making imports cheaper, therefore lowering inflation. But tracing back to your previous point over there, being the Malaysian ringgit weakening against other currencies due to our policies, etc., our economy, our competitiveness index is also dropping lower and lower. Yeah, the evidence is right here, lah. Because more recently, the Singapore government, their forex reserves is steadily increasing. This means that they have not been really intervening in the FX markets in terms of strengthening the Sing dollar, right? Does it? Am I right to say this, Mr. Sani?
So I can't really see the chart, but yes, if you're saying that the foreign reserves are increasing, then probably they would not have been intervening. You're right.
Yeah. So, what is the long term? I mean, let's not go long term now. After that, we will talk about long term. Let's say short term wise. What is the short term like projection for the Sing dollar at least? Do you think this year you'll reach like 3.6 or 3.7? Because this article over here indicated that MAS is expected to keep the monetary policy tight. Inflation in Singapore has continued to persist. I think the most recent inflation figure in Singapore, overall inflation missed expectations, right, Mr. Sani?
Yes, I think they will. Like the article mentions. So I think if you're talking about the Sing Ringgit itself, there is a likelihood that it will continue to move higher, albeit We've seen some foreign buying on the stock market. Those are basically short-term flows. It could be long-term flows, but basically currently today, or rather over this short period of time, we've seen a lot of inflows there. So that could offset some of the weakness in the ringgit, because that sooner or later will translate into or already is translating into inflows into the you need ringgit to basically invest in the stock market if you're a foreigner.
Right. So, short-term wise, we are not really surprised that if the Malaysian ringgit continues to depreciate, let's say around 3.6 to 3.7, So I don't think you will be surprised also, Mr. Sani, because MAS is expected to keep their monetary policy tight. And this brings us to our last point of the night, right? Which is the importance of diversification, ensuring that, even though we stay in Malaysia, we have some assets exposed to overseas. Not just US assets, but SGD denominated assets as well. Now, you've been living in Singapore for, I think, over 30 years, Mr. Sani. If you're a
Yeah.
Malaysian, what are the ways or what are the alternative methods for Malaysians to perhaps diversify into SGD assets? Do you know of any methods?
Well, there are, I won't mention the name, but there are unit trusts which basically invest in Singapore. There are some which are a little bit more heavily biased towards Singapore bonds. Because again, if you invest in something which invest in Singapore equities, you take on the equity risk, which could offset what we call the FX gains. So one of the cleaner ways of getting an exposure to Sing dollar is to invest in a Singapore bias, or at least Singapore bond heavy unit trust, and there are some out there. So we've asked our clients, for example, to do so, and as you correctly mentioned, the gains over the past two years or so has been quite attractive, and it's solely from the currency side.
Yeah, there are a lot of other methods to diversify into the Sing dollar as well. First of all, is fixed deposits, but that requires you guys to at first own a Singapore bank account or open a foreign currency account. This one, I think right now only CIMB over here locally is offering
Yeah,
a very
yeah.
attractive deal in terms of a foreign currency account.
Of course, it's almost impossible for you to open a Singapore bank account without a Singapore domicile address. So I think this way you're mentioning about if CIMB offers it, then probably that's the easier alternative.
Yeah, but this is worth considering also lah, Mrs. Sunny, because another thing
Yeah,
about
you get a direct exposure. Yeah.
we get a direct
It's as good.
exposure.
It's as good as you go to the money changer and change that your ringgit to Sing and keep paying it, I guess.
But my impression is that I've been checking the rates provided by CIMB, and it is honestly quite bad lah compared to the market rate. You incur like a 2 to 3% loss. For buying the Sing dollar right now, I think it's like 3.66 or 3.67, whereas the market rate is 3.57. There's a huge deviation. So I guess for those people who are interested to open a CIMB foreign account, it only works if you have a longer time horizon, because apart from getting exposure to SGD and holding SGD itself, CIMB allows you to place that balance into fixed deposits. And last I checked, the fixed deposit for Sing dollars is 3.5% for 12-month tenor, which is not too bad. But if you have a short-term horizon, then obviously you won't make a lot of profits. In fact, you might lose some of your money because the exchange rate provided by banks is just not very favorable. So that's one of the first ways, and you talked about another way also, which is buying SGD unit trusts. And locally, well, you won't mention the name, but I think a lot of people know this name, Mr. Sunny. It's probably Mutual, and many other banks out there are also offering different types of unit trusts that have exposure to the Singapore dollar. Just make sure you guys check the fund prospectus and take a look at the fees.
The unit trust denominated in Sing in itself is not enough, because if you're buying into an equity, you are exposed to the equity volatility. So if your Sing dollar could strengthen 3%, 5% against ringgit, okay, so you have FX gains, but your Sing equity could go down by 5%, so you effectively don't make any money. And that's why I had alluded to the fact that it's the bonds centric unit trusts, Sing bond-centric unit trusts, which are more stable because bond prices don't typically move that much. So there's a lesser chance of the bond, a negative bond performance, eating up your so-called Sing dollar FX gains.
Yeah, so just to track back on your point just now, Mr. Sani, when we talk about Singapore equities, how has the Singapore market performed? Let's not compare to the US market, because US market is just every day making a new all-time high. But how has the Singapore market performed compared to the Malaysian market? Is it like slightly
Now,
better, or are we talking about worse, or what?
I haven't done a side-by-side comparison, but it's just sideways over the past couple of years, similar to Malaysia, I guess.
Okay, it's not no surprises over there that you recommend that, get exposure to mainly those lower risk assets.
If the view is that you want to make currency gains or you want to put a bet on the currency, then you don't want your underlying asset fluctuation to wipe out your currency gains. So effectively, you try and get the asset with the lowest volatility, and in this particular case, it's a bond. Yeah.
Yeah, yeah. And the last method which we'll be talking about tonight to get exposure to SGD assets is this new fund over here offered by Versa. They said that this is a moderate risk fund. They invest in reputable assets from financial institutions, banks, real estate giants, yeah, OCBC, UOB, CapitaLand, Ascendance REITs, all major players in Singapore's thriving economy. So probably it is an alternative way for Malaysians to get exposure to the Sing dollar. What do you think, Mr. Sunny? Surface wise,
That,
surface
that's
wise.
that's what I was mentioning. I say if this is into the shares of what you just mentioned, the banks and some REITs and such, you are exposed to the decline in the performance or share price. Correct?
Right,
So,
right, right, right.
I give you an example. In Japan, the Nikkei went up 30%, but the yen dropped 30%. Net, you didn't make any money. So in this particular case, it's the other way around. Your Sing could strengthen against the ringgit by 10, 30%. Let's say, for example, extreme 30%. But if your share price drops by 30%, it's also back to zero. So when you buy something like this, and again, I can't see because I'm driving. Sorry, I can't see the actual details of this fund itself. But if this fund is invested in, let's say, for example, you mentioned a few names, UOB. I don't know whether you mentioned OCBC. All these are shares of these banks. They're good names. They're blue chips, except that they are on the stock market. So if the US tanked by 10%, hypothetically, the Sing market, Singapore STI followed suit and tanked by 10%. And all these blue chip shares tanked by 10%. Your 5% gain on your Sing ringgit wouldn't make a difference because you'll be down by -5. Yeah. So effectively, if it's equity-based underlying still an equity, you are still exposed to the prospect of not gaining on the currency side because the equity losses. But it could work the other way. The equities could go up by 10, currency could make 5, and you end up with 15% overall. You could also gain from it. It's just that you are exposed to this swing in the equity side.
So here is the
Correct.
breakdown lah. It's 63.4% fixed income, 30.2%
Okay.
equity, 6.5% cash. So I'm assuming that the 30%
Ah,
equities within the fund itself goes to these groups like DBS,
okay.
OCBC,
Okay.
UOB, etc. So does that, increase the attractiveness of the fund itself? Because why I want to focus about this is because that it's a new fund, and it is very easy for Malaysians to get exposure into SGD assets rather than approaching a manager manually, learning more about different types of unit trusts, being charged high fees, etc.
I mean, you as long as you go in with your eyes open, you know that the majority is fixed income, fine, but you still have a component which is tied to equities. So you just have to, once you understand that, if, for example, you happen to be in a situation where the equity markets drop, just don't be surprised that your Sing dollar had strengthened, but you still don't end up with a gain. But you, as I mentioned, you go in with your eyes wide open, then shouldn't be an issue at all.
Yeah. All right. Right. So I think we do have quite a few questions already, Mr. Sunny. The first question is how can we start investing in SG assets, which we already answered. and we've broken it down into three different parts, right? It's the fixed income section where you talked about investing in mainly safer assets, your treasuries, bonds, okay, getting exposure to those unit trusts that are heavily denominated in these assets, and then registering for a foreign currency account with CIMB. That one has a few cons lah because the exchange rates are often unfavorable, but it allows you to place the money into fixed deposits, right? So you can grow your money by quite a bit. And finally, it's Versa SGD, lah, this new fund over here that invests your money mostly into fixed income, but it has some of the equity risk as well, which Mr. Sani mentioned. If the markets, fluctuate and perform badly, then don't be surprised that your profits will reduce as well. So the other question is, I'm currently working in Singapore. Wow, okay, you can meet with Mr. Sunny lah because he's currently in Singapore as well. Can I know which is more profitable for me to save money? To save money in SGD bank account or EPF or ASB? Ooh, touching a bit more on the financial advice realm already lah. But your thoughts so far, Mr. Sunny? Just give like a general opinion.
Actually,
Yeah.
it's a good question. One which is, I guess it's not easy to answer. Okay, so if you work it out quantitatively, meaning to say that Singapore banks currently give, let's say, 12 months, as you mentioned, 12 months fixed deposit, 3.5. You are assuming that the Sing may strengthen another 3%. So net, you would walk away with about 6 to 8%, let's say, for example, on a per annum basis. If you look at your EPF and ASB, they would give you what, 5-6%. Okay, so but that's more or less, I won't say guarantee, but it's around there. So you'll be taking a bit of a bet that the so-called Sing returns against ringgit is consistent at 3, and the Singapore rates are here. So I think from that basis, if you do those assumptions, putting it in Singapore probably looks a better bet at this point, until the day where the Sing rates fall below. The let's say Sing FD rates go back down to 1%, then maybe it's a bit more even out where you want to put it. So I think that's the thing. One thing you may want to remember, not so much of the returns, but I think in terms of the flow, it's easier to send money from Singapore. Let's say you convert it to ringgit. It's harder for you to reconvert the ringgit back into Sing. Especially if you're talking about large amounts, because again, I think bringing ringgit or converting ringgit back, converting ringgit out of Malaysia, I think there's some FX restrictions.
Yeah, so those are the few things that you need to take note of lah. But if I were to approach this question itself, lah, maybe is it wise to split, like do like a 50-50 split, 50% you save HD in the bank account, and then like 50% save into EPF or ASB, just so that you can have like the best of both worlds? Or we determine a percentage ourselves where part of it I want to contribute 20% lah to EPF or ASB every month, and then the remaining 80% I save inside my SGD bank account, so that I do have like a bit of exposure in MYR just in case that MYR strengthens as well. Do you think this is like a prudent option?
I think it really depends on the individual, how
Yeah,
strong
depends.
he or she believes in a certain assumption. But if you have no idea, then I think your method of 50-50 is just fine also.
Yeah. Okay, so fixed income in this case is bonds. Yeah, so basically
Correct.
fixed income, fixed income is mainly talking about the lower risk assets, treasuries, bonds, government securities. What else, Mr. Sunny? What else is there? There is like I think that pretty much covers the list already, right? That's
Pretty
fixed
much,
income.
it's just that fixed income has a wide range. You're talking about everything from government bonds, which are safe, to corporate bonds, to high yield bonds, to other fanciful ones like convertible bonds and such. But I think most of the time when I see funds investing in Singapore, it's just the traditional, pretty safe type ones. But again, you need to read the mandate of the fund.
Right. So for those of you guys who currently have like a Singapore bank account, right? Fun fact, you can actually send Malaysian ringgit over to your Singapore bank account. You can convert Malaysian ringgit to SGD and then send it over to your Singapore bank account instantly, with either Wise or Touch and Go Remit. Okay, so but then the amount is capped for Touch and Go Remit at I think 30,000 ringgit a day. So the rates are actually pretty competitive. Below 1,000 ringgit, Wise roughly charges about 1% fee. Above 1,000 ringgit, then it's more better to use Touch and Go Remit. In that case, the fee will be like much lower as your amount goes higher. Like. So I just feel that you guys should know about this. You know, Touch and Go allows you to send money overseas, not just to Singapore, but to other countries such as the UK. I think Japan is also in there if I'm not mistaken. So later after the session, I will send you guys a few links and you can read more about it. So I think one of the last questions over here, I'm looking at SG. There is an app known as Scythe. Is it any good?
So I can't comment on whether it's good or no good, but you need to do your own research. But there are several robo advisors here. You just probably do a search, you'll be able to see Endow, Scythe, and maybe one or two others. One of them closed down, I think Money Out or something like that. I can't recall the name. But it's a robo advisor basically.
Yeah, so what are your thoughts on robo advisors? Is it like something that investors should look at, or we stick with the
If
yeah, yeah.
Well, it depends. I think it's a combination of things. Some in people robo advisors are cheaper compared to if you speak to let's say a human advisor most of the time. The robo advisors they come out cheaper. So people who are new, young, and savvy with technology believe in the fact that I don't need an advisor to talk to me. I just want to invest couple hundred dollars or a thousand, few $1,000 and such. That's fine. Some people who are older with much more complex situation, 200,000, half a million and stuff. Most of the time, again, they still could invest in robo advisors, no issue at all. But we tend to see them preferring to talk to a human advisor because the amounts are large. They want to ask questions. They want to bounce ideas off the advisor and such. So they tend to prefer speaking to financial advisors. Because most of the time their plans would incorporate sometimes life objectives, financial objectives, which need a bit more human interaction. Oh, by the way, I want this amount at this particular point, but then later on, I want this amount. I want to reduce it. I'm going to get a bonus. I'm going to introduce. So a lot of complexity, which I think at this point, robo is pretty straightforward. One objective, one kind of time frame, and so on. Of course, you can do it a bit more complex wise, but like I mentioned, the demarcation that we see most of the time is in terms of size, i.e., the higher the investable amount, the more tilted towards human advisor for the investment.
Yeah, so it entirely depends on how much you're planning to invest, as well as whether you're tech savvy or not. So in the topic of robo advisors, locally, Wahed is one of the very well-known robo advisors. So you may want to take a look at it, or change your investment strategy or whatnot, depending on whether you're tech savvy and your investment amount as well. So, on to our last question. I think there are no questions from the community right now, but I do have one final question for you, Mr. Sani, before we end the session. Let's say, this Malaysian over here, he wants to diversify into SG assets. His portfolio is mainly denominated in MYR, comprises of maybe ASB, some fixed deposits, etc. And then he looks at the depreciation of the Malaysian ringgit, and he's very interested to diversify into the Sing dollar. In that case, what sort of like a portfolio breakdown would you recommend? Would you recommend like 80% into MYR, 20% into SGD, or like a different sort of percentage depending on their age or whatnot?
Okay, so again, this is very generic in nature.
Yeah,
Sometimes it
yeah,
depends on individual case by case basis. Yeah, but we typically, because when you move into SGD, like I mentioned, it really is a question. Number one is it an equity exposure or is it a bond exposure? Okay. We tend to think that if it's an equity exposure, most of the time single country, it will then be considered as a single country exposure into Singapore. We would limit it to 10% of your portfolio. Okay, so that would be the case. If it's a bond exposure, we tend to have a little bit more leeway, and because it's in Sing and historically Sing has done well, we think that maybe it can even go up to 20 odd percent, maybe even 30, for example, especially if the client already has assets in Singapore, has some use, is familiar with the currency and such. Yeah, so that would be the case. So again, it's very generic kind of advice. I'm not trying to say it's specific to any one of you. You really need to sit down with your financial advisor if you have intention to do so.
Right. And that brings us to the end of our session tonight, guys. Hopefully, you guys learned something and enjoyed our presentation talking about the Singapore dollar. Really, just to quickly summarize, everything. Singapore dollar is mainly strengthening the past 2 years, 2021 to 2023, because of the Monetary Authority Singapore, or the Singapore Central Bank, tightening the monetary policy and directly buying up Sing dollars in the market, therefore strengthening the local currency in order to keep a lid on inflation. Okay, and things are not looking good for the SGD-MYR pair. I mean, things are looking great for the SGD-MYR pair. What I'm talking about is the Malaysian ringgit, because Singapore, they are expected to keep the monetary policy tight. Inflation continues to persist. So, like what we covered earlier during the session, it's no surprises if in the next few months or next few weeks, SGD rallies to 3.6 or 3.7 due to this inflation factor over here. But obviously, other factors like what you mentioned just now, also MYR could see some inflows, right, due to the Malaysian market, Malaysian ringgit weakening, and then attracting more investors to come into the Malaysian market, right? In order to invest in Malaysian market, they have to first buy up some ringgit lah. So make sure you, I would say, manage your risk accordingly. Don't like be gung ho, like what you always say lah, Mr. Sani. Don't be gung ho and try to go too much into one asset, and then at the end of the day regret lah. Yeah. So Mr. Sani, last words from you before you wrap up the session.
Not much. I've actually said a lot. But if it's on the subject of Sing and Ringgit, I think at the end of the day, it really boils down to whether Malaysia can get its act together. If it does, then I think it has a good chance of strengthening not only against the Sing, and again, everybody effectively struggles against this thing, because again, as we mentioned, Sing is kind of a lack of a better word, one way in a way. So the baht, the rupiah, the pesos, Philippine peso, everybody is kind of losing out to the Sing. But if the ringgit can get its act together, then you'll find a stronger ringgit baht, ringgit rupiah, ringgit peso, and so on and so forth. So I think hopefully if we get our act together.
Yeah, big if over here. Okay, but I would say let's keep our hopes up and see where the ringgit goes in the next few weeks or months. And that brings us to the end of our session tonight. Hopefully, you guys learned something. Shout out to all our members. Thank you all for supporting the futurists: Andrew, Wendy, Edward, Alex, Sissy, Irshad, Caveman Balls, Kelvin, Tommy, Jinkang, Adrian, JS, Wenyan, Dean, Duhan, Sufi, Faris, Alan, Jackson, Ryzan, Hudson, G, Jeffrey, Lawrence, Lukman, Lufeni, Will, Jack, YC, and Arif, as well as all of our learner members. Good night, everyone. Stay safe.